By now you've probably heard about the Silicon Valley Bank's collapse and how it sent shockwaves throughout both the US and the world economy as a whole. But what you need to understand is how it happened, why it's impacting the larger banking industry, and whether or not your money is safe. I'm Bradford with the Penny Pincher's Guide to Personal Finance, and to understand how we got to where we are now, we need to understand a little bit of the history behind Silicon Valley Bank. So the bank itself was founded back in the 1980s, and at the end of 2022, they were part of the 20 largest banks in the United States, managing over $200 billion worth of capital. Their primary customers were those in the Silicon Valley area, particularly a lot of startups in both the tech and the healthcare industry. Now, one of the preferred reasons why a lot of these customers use Silicon Valley Bank is because they were very friendly towards venture capitalist startups, and they were willing to give money and lend out loans towards other places that other banks wouldn't do because of the higher risk associated with it. Now, where the current situation really started was back in 2020. As we entered the pandemic, we saw the tech stocks and a lot of things in that industry really start to boom as everybody was locked down in their homes. A lot of people started to turn towards online, getting on Facebook, YouTube, Google, things like that, and spending a lot more time there. So tech industry really soared while everything else in the stock market really saw a depression as people had to cut back on spending and a lot of smaller businesses closed. Since Silicon Valley Bank was already so integrated with the tech industry itself, a lot of their larger customers, since they did provide funding for over half of the startups in the area, a lot of them took their money, took that influx of cash that they were getting, and invested it with Silicon Valley Bank. And it was with that influx of money that really the problem started. Now, instead of deciding to diversify their investments, they really chose to really just go all out with long-term bonds. Now, the problem with long-term bonds, if everything goes according to plan, there really isn't one. They're going to be able to take the interest from those bonds and then pay it out to those customers and the interest that they make on their checking and savings and business accounts. But the problem comes into play because we do use a fractional banking system. So banks don't hold all of the money that is deposited with them. They lend it out to be able to make money on the difference between what they earn in interest and what they pay out to their customers. Now, because they were so consolidated in long-term bonds, that wasn't really an issue until we started to see inflation soar coming at the end of 2020 into 2021 and through the current year of 2023, where we're still seeing those record highs over the past few decades. Now, if nothing else had changed other than the inflation, that wouldn't be an issue. But where the issue came is because the Federal Reserve, the job is to maintain a lower inflation rate to be good for the entire economy. They had to start fighting that. And to do that, one of their principal tools is by raising the Federal Reserve rate, which in turn is going to affect the banking rates for everyone else. Now, one of the chief things that happens when the Federal Reserve rate is increased is that the interest rate on Treasury bonds also goes up. Now, the increased interest rate on new bonds doesn't hurt any existing bondholders because they're still going to make the money that they were originally promised unless they have to sell them on the secondary market. And now that really comes into play on the tail end of 2022 when a lot of tech companies were finally starting to see the issues with high inflation and they were burning through cash and they were finally having to contract their businesses. Google, Facebook, Twitter are some of the big names when it comes to the large tens of thousands and hundreds of thousands of employees that were laid off in the tech industry. Now, with these companies burning through their cash reserves, they're finally having to start to pull out that money. Now, since they are pulling out so much money and a lot of them were invested in Silicon Valley Bank, that is forcing Silicon Valley Bank, because they have to maintain a certain amount of cash on hand, they're having to sell off those long-term bonds in the secondary market. Now, if you're looking at somebody who's going to choose whether they're going to buy something on the secondary market or buy a new bond, they're looking at something that was paying out 2 to 3% interest on the secondary market, or they could buy a new bond that's selling between 6 to 8% interest rate. Now, no one in their right mind is going to choose to buy that lower interest rate unless they get it at a hefty discount, which is what Silicon Valley Bank was forced to do when they had to start liquidating those long-term assets that they had to be able to give their money back to their depositors. So they start hemorrhaging money. They start losing a ton of money because they're losing money on the assets that they had invested in to be able to give it back to the people whose money it properly is. But as we go from 2022 into 2023, the real problem really hasn't reared its ugly head yet. Now, when it really starts to show and the panic starts to set in, which causes a traditional run on a bank, it happened on March 6, 2023, when Silicon Valley Bank tried to raise capital in the amount of $1.75 billion. This is where the panic really starts to set off. People start to wonder, particularly on Twitter, why is this bank trying to raise so much capital? And that is what fuels the fear that they are actually running out of money and there's not enough capital and assets behind the bank for everybody that has their deposits there. So then, as we see through the end of March 6th into March 7th, a traditional run on the bank happens. This phrase comes from back in the 1929 with the Great Depression and the crash of the stock market, when people would literally run to the bank to try to withdraw their money because they're in the fear that there's not enough money available and they want to get there first so that way they can pull their money out so at least they get their money even if there's not enough money to go around for all of the depositors. Now, if it was just a lot of individuals that were investing their personal money in the bank, it probably wouldn't have happened so quickly. But when you have these large tech companies that are trading in the billions and tens of billions of dollars, they are going to be eliminating the available capital extremely quickly. And that's what led to March 8th, when the FDIC shuts down the bank. Federal Deposit Insurance Corporation closes the bank and promises that everybody is going to get the money that is FDIC insured. Now, for the individual, you probably see FDIC insured on anywhere that you bank. Now, that means that anybody that has their money deposited into a checking or savings account, that money is preserved by the federal government up to $250,000. Now, for you and me, that's probably not going to be a big issue, and we feel very comfortable with our money being in there. But if you're one of these tech companies that has billions of dollars invested in cash, that means they are really out of luck when it comes to recuperating the money that they had invested in the bank. So that covers the how of the Silicon Valley Bank collapse. Now, for the why this has an impact on the larger banking industry as a whole. With the run on this bank, people started to look at their own respective bank wondering, is my bank secure? Now, the largest banks like Bank of America or Chase Bank, they really aren't in danger of going under, but a lot of regional banks, if they've decided to engage in an investing strategy that is not diversified, can definitely put them in danger of collapse. Two more larger regional banks have collapsed, one in the United States and then one in Switzerland, both that have been bought out by larger banks respectively. But then beyond the three banks that have currently gone under, Moody's has also placed 6 additional regional banks on the high risk rate because they have low assets on hand, as well as the large losses that they've been reporting. So any of the banks that have been investing large sums of money in long-term treasury bonds have been failing to identify what is currently going on and assuming that the Federal Reserve is not going to continue hiking interest rates. For as long as those interest rates continue to go up, if those companies have a large amount of their assets invested in long-term bonds, then they are at a high risk of being illiquid and having to suffer tremendous losses if people start to withdraw a large amount of money from the bank. Now, for the question as to whether or not your money is safe. If you are like most people that have less than $250,000 invested in their bank, whether it's in a checking account, high yield savings account, money market account, any of those things that are FDIC insured, you can rest safely knowing that your money is going to be covered. Even if your bank goes under for having bad investment practices, your money is covered by the FDIC and you will get it back. But for those that have larger amounts than $250,000, while that doesn't make sense for most individuals to have that much money just sitting around in cash, if you're a business owner, small business owner, corporation, you might need well in excess of $250,000. It could be millions, tens of millions, or even billions of dollars on a daily amount just to be able to deal with your daily accounting. And so if you do fall into the latter bucket of having to maintain such a larger amount of capital and cash on hand, you need to really look into the accounting practices of where you bank to understand how they're deciding to invest your money and whether or not they're using safe business practices that make sense for you to continue leaving your money invested with them. But regardless of who you bank with, it's always a good idea to do continual reassessments as to whether or not who you're banking with is the best place to put your money at any given point in time. And I'd highly recommend checking out our review of the best high yield savings accounts of 2023. Thanks for watching, and from your first penny to your first million, we're here to help.